The modern Canadian financial crisis happens in silence. It is written into the proprietary code that determines who is allowed to access capital and who is forced to lose their home. Most of us focus on the three-digit number provided by Equifax or TransUnion, but that score is a marketing layer, and beneath that number lies a much more complex engine. Banks now utilize internal behavioral surveillance systems. These models track daily habits in real time, assigning a risk value to every minor fluctuation in a household's spending. This makes the consumer-facing score a lagging indicator. By the time your public credit score moves, an automated system has already made a decision about your future. Data from the Canadian Financial Diaries shows that 10% of adults in this country do not own a credit card. Because they don't use revolving debt, they cannot generate the specific data points these underwriting models require. For those who rely on cash or debit for survival, the result is data poverty. In the eyes of an algorithm, a lack of digital footprints makes a citizen mathematically invisible. The Bank of Canada's research highlighted individuals who tried to build their scores by using credit cards and immediately paying off the balance. This responsible behavior is often misread by the software as a thin file, signaled by a lack of sustained credit history. Avoiding debt is a survival strategy, but algorithms treat this as an unquantifiable risk. The Bank of Canada models default risk using a formula measuring credit utilization against baseline scores. For wealthy borrowers, sudden utilization spikes are mathematically ignored. But for a working-class borrower at 660, the formula multiplies the penalty, instantly signaling a terminal default trajectory. To understand what is actually driving these decisions, we have to look at Shapley value decomposition, a method used to see which variables are doing the most work in a model. This is a breakdown of the Shapley data. The baseline credit score accounts for only 29.1% of the model's predictive power. The remaining 70.9% is determined by dynamic behavioral data, including utilization spikes and minor arrears. Because these behavioral signals appear in real time, the bank identifies a failing borrower long before the public credit score reflects any trouble. Prime lending is increasingly concentrated at the top. Currently, 66.1% of all new uninsured mortgages are reserved for borrowers with scores above 750. While traditional banks tighten standards, alternative lenders have grown to $11.4 billion in assets. This represents trapped borrowers unable to leave. Paying high interest rates keeps their utilization high, mathematically preventing them from ever refinancing back into a traditional bank. For these households, the alternative market has transitioned from a temporary bridge to a permanent sector for those the prime models have rejected. We are seeing the results of this exhaustion in Ontario, where mortgage delinquencies have risen 44% year over year. Between 2025 and 2026, 2.18 million low-rate mortgages face renewal. High-score households will manage the transition, but working-class borrowers with high utilization will trigger automated rejections, pushing them toward the higher rates of the alternative sector. Public sector AI tools, like those used by Statistics Canada, are governed by the Directive on Automated Decision-Making to ensure fairness. Private underwriting algorithms, however, operate without these transparency requirements or federal oversight. To bypass these barriers, many are forced into co-signing, anchoring the pristine credit of the retired generation to the heavy debt of the young. Until these private financial models are held to the same standards as public tools, credit scores will continue to function as a mathematical mechanism for exclusion.